I heard someone say Australian property prices always go or that you need a massive deposit to get started. In 2025, believing these myths could cost you serious money. Today, I'm going to bust the five biggest Australian investing myths, and number three might shock you, especially if you love tax refunds. Stick around for a bonus tip at the end that give you an edge this year. Hey, I'm Anik, your Aussie property guide. Whether you're a first time investor or you have already got a portfolio, the game has changed here in 2025. After a roller coaster few years, pandemic booms, interest rate hikes, and now a shifting market, it's more important than ever to separate facts from fiction. These myths we are about to bust are ones I hear all the time, and they can lead you to down to the wrong path. By clearing them up, you will invest smarter and avoid expensive mistakes. And make sure to stay till the end for the bonus strategy. It's a good one. Ready? Let's dive in. Myth one: property prices may go up. This is probably the granddaddy of all myths. We have all heard the saying that property values double every 7 to 10 years or that real estate is a big thing. But the truth, property prices do not just endlessly rise. They move in cycles, they go up and down. For example, my towns boomed decades ago, then went bust, taking ages to recover. Even big cities had corrections. Sydney home prices fell by about 12% in 2022 during the interest rate surge. So, no, it's not always sunshine and rainbows. Over the long run, well located properties do tend to increase in value, but you must be prepared for flat periods and the occasional dip. The key is understanding the property cycle and buying with a buffer so you can ride out any downturns. Don't assume your property will make you rich. You need a smart strategy and bit of patience. Time in the market beats trying to perfectly time the market every day of the week. Myth two: need a huge deposit, a big dollar value to invest. How many times have you thought, can't invest in the property until I have saved 20% deposit? That's hundreds of thousands of dollars. This myth stops a lot of people from getting started. Sure, a bigger deposit helps, but you don't necessarily need 20%. In fact, some lenders will accept as little as 5 to 10% deposit for a loan. That means you can get your foot in the door sooner. You might pay lender's mortgage insurance if your deposit is under 20%, but it can be a viable trade-off to start investing earlier. There are also government schemes for first home buyers that allow purchasing with a 5% deposit and no loan mortgage insurance. Essentially, the government acts as a guarantor. And let's not forget the creative strategies like rentvesting. More on that in the bonus. Or buying in more affordable markets. Plenty of everyday Aussies and average income have started with a small deposit and a leveraged up. It's not just a rich person's game. The myth that you must be wealthy upfront is outdated. Smart use of borrowing to buy quality assets is how many investors build wealth. So, if you can budget for the repayments and have a buffer, don't let a small savings pool stop you. Start where you can. In property, it's all about the tax breaks. That's the old gearing will make limit. In Australia, we love our property tax deductions, interest, depreciation, etc. But here's the reality. Investing solely for tax benefits is a misguided strategy. Tax deductions like negative gearing are nice perks, but not a profit plan. Think of them as icing on the cake, not the cake itself. You should never buy a property that's a dud just because you can claim some loss on tax. Ask yourself, what's the point of getting a $5,000 tax refund if a property's value is stagnating or the rent isn't covering costs? You are still out of pocket. The real goal is to buy properties that grow in value and produce income. Those capital gains over time and solid rental yields are what build your wealth, not a few tax dollars saved. Remember, the AQ isn't going to bail you out if you make a bad investment decision. By all means, enjoy the tax deductions you're entitled to. They can help with cash flow, but don't make them the reason for buying a property. Focus on the deal itself, location, growth, potential tenant demand. A great property that makes money will also give you tax benefits. A poor property that bleeds cash is just a bad investment. Even if it is, as they say, don't let the tax tail wag the investment dog. Myth 4. Brand new properties are the best investments. Shiny new apartment building versus older house. This one is super common, especially with all the flashy developer ads, new house and land packages, newly built apartment. You're like, new, what could go wrong? Plus, new properties come with builder warranties, modern features, and depreciation tax benefits, right? The myth is that new equals to guaranteed great investment. But the fact paints a different picture. Often, when you buy a new or off the plan, you're paying a premium just to be the first owner. Developers and marketers bake their profits into that price. And guess what? That shiny new unit can lose value the moment it's no longer like driving a new car off the lot. Meanwhile, that premium you pay doesn't guarantee capital growth. In many cases, established the slightly older houses with good outperform new builds because they have what really counts, land value. Remember, land is what appreciates, not building on it. A high-rise apartment might have very little land component, and there could be dozens of identical new apartments competing with yours, not exactly a recipe for scarcity of or capital growth. In fact, units and apartments tend to be more volatile in value. As one expert noted, saturate themselves quickly. Demand for units is far lower than for, which means less competition and slower price rises for unit owners. Currently, the vacancy rate for units is around 2.5%, more than double that of houses, which is around 1.1%, indicating weaker demands for unit nationally. None of this is to say you should never buy new. Just don't fall for the myth that new is automatically better. Do your homework. Is that new development and in an oversupplied area? Are you paying top dollar for a cookie cutter apartment when you could buy an established place down the road on a bigger block of land? Oftentimes, a 30-year-old house on a well-located piece of land will deliver better growth than a brand new build in a far-flung estate. The bottom line, invest with your head, not just your heart. Or love of new appliances. The smell of fresh paint is nice, but profit is nicer. Myth number 5. Market is about to crash. It's too late or too risky to invest now. This myth flares up whenever property prices have been high or when interest rates rise or interest rates fall. It usually goes in a bubble. I will wait for a huge crash and buy dirt or booms over. You have missed the boat. Here's the thing. People have predicted an Australian market crash every year for 20 years, yet we haven't seen a US-style 40% wipeout. Instead, what we see in many markets moving on cycles, Australia isn't one market, it's a bunch of them. Prices might be dipping in one city and soaring to new highs in another. Case in point, in 2024, Perth and Adelaide were rocketing up while Sydney and Melbourne cooled off, all at the same time. By mid-2025, after a brief downturn, property values rebounded and hit record highs across multiple capital cities. If you were sitting on the sidelines waiting for an epic crash, you would have missed those opportunities. Now, can prices pull back? Sure. 2022 taught us that rising interest rates can cause a correction, but even then, the drops were mostly single-digit percentages of the nation, and within a year or two, the trend shifted again. The market finds its balance because of fundamentals like population growth, housing supply, and the economy. In 2025, we still have a housing shortage, vacancy rates super low, and strong demand from migration, plus interest rates, and while higher than the emergency lows, have started to stabilize. Plus interest rates, while higher than the emergency lows, have started to stabilize. A lot of investors actually see now as a time to buy the right property at maybe a slight discount before the next upswing. In fact, a recent survey found that nearly 1/3 of property investors plan to buy in 2025, despite high rates and living cost pressures. The highest intent since the post-COVID boom, They are not sitting around waiting for Armageddon. They are out there looking for deals. The lesson? Don't try to time a mythical part of the market. It may never come. And even if prices dip, good luck guessing the exact month before they're rising. Focus instead on finding value and buying when you're finally or financially ready. If a property meets your criteria, affordable, good location, solid yield / growth prospects, that's your green light, regardless of what the headlines say. Over the long term, well selected properties tend to reward those who hold on. As the saying goes, best time to buy property was 20 years ago. The second best time is now. The strategy. Congrats for sticking around. Congrats for sticking around. You have earned a bonus tip. This one's special for those feeling priced out of the city they live in. Ever hear of it's becoming a bit of a buzzword? And for a good reason. Rentvesting is when you rent where you want to live, but buy an investment property where you can afford to buy. Essentially, you can become a tenant and a landlord at the same time. Why consider this? Well, maybe you love living in a Sydney beachside suburb or a trendy Melbourne area. Great lifestyle, but buying there is quite expensive. With Rentvesting, you continue renting in that dream location, enjoy that beach or cafe culture, and you purchase a property in a more affordable market, which you rent out to tenants. This why you get on the property ladder without sacrificing your current lifestyle. Your investment could be a house in a growing regional town or in a different city where prices aren't so crazy. The rent from your tenants helps pay off your mortgage, ideally, and you're building equity over time in an asset that's going up in value. Sounds a bit out of the box? It is, but it's increasingly common. A recent survey found 54% of first home buyers could consider rentvesting as a strategy, which is up from previous years. Even some experts predict it could become the for younger investors if affordability stays tough. The beauty of rentvesting is flexibility. You're not tied down to a massive mortgage in the city you work in, yet you are not missing out on investing while you wait to afford that dream home. You can live close to work or the beach and have your money working for you elsewhere. Of course, as with any strategy, do the math. Ensure the investment properties numbers stack up. Don't buy a dirt just because it's cheap. And be mindful that as a renter, your living situation isn't as owning. Leases can end. But many find the pros outweighs the cons. If you have done it right, rentvesting can fast track your wealth building. You might even use equity from that first investment to later buy your own home, if that's your goal. So it's one more strategy to keep in your toolkit as an investor in 2025, and a bonus tip to boot. I hope this has helped you see the Aussie property market in a bit clearer lens. Now, before you go, I got a little something for you. I'm giving away a free book on property investing. It's packed with tips on how to find the right properties, financial deals, and avoid common pitfalls. Grab your free copy. The link is in the description below, and dive even deeper into those topics. I wrote it to help investors like you to succeed. If you have enjoyed today's video, do me a favor, hit the like button to let me know and subscribe to the channel for more no BS property insights every week. Join our community of investors, whether you are just starting or scaling up. We are all here to learn and grow together. Got any other myths you have heard or questions on your mind? Drop a comment. I would love to hear what you think. Thanks for watching 5 biggest Australian property investing myths busted for 2025. Remember, the best investor is an informed investor. Stay savvy, keep learning, and I'll see you in the next video. Happy investing.